we need to fight inflation. The way you fight inflation is taking away buying power from people. I mean, that's how you do it, right? You said, okay, now you're going to borrow less, there's going to be less liquidity and so on at the time that there's more inflation. So it's not like fighting inflation is one of those things. We fight inflation and that's a good thing and we'll get on with it. It means taking away buying power, and that causes markets to go down and that causes economies to go down. So that's why we've entered a period of stagflation. That's why we're in a period of stagflation.
Over the past week, there's been a lot of talk about the United States economy being in a recession, a period of economic downturn commonly defined as 2 successive quarters of declining gross domestic product. As worrisome as an extended period of economic decline is, a significant number of economists and other market experts believe we could be heading for greater economic woes. According to a mid-year survey conducted by the Securities Industry and Financial Markets Association, 80% of economists agree that stagflation is a greater long-term risk to the economy than recession. In addition, a recent Bank of America Global Fund Manager survey found that stagflation fears are the highest they've been since June 2008, while inflation refers to a general increase in prices and a fall in the purchasing power of the dollar. Stagflation occurs when there is a period of stagnant economic growth combined with high inflation and high unemployment. Unlike recessions that occur periodically, stagflation is rare and can be very difficult to tackle with lots of devastating effects for all categories of investors. The combination of high inflation and a high unemployment rate poses quite a challenge to central banks because they need to raise interest rates to combat inflation and also reduce them to reduce unemployment. A good example of this toxic combination occurred in the 70s and lasted for over a decade. In a recent interview with renowned author and motivational speaker Tony Robbins, billionaire investor and veteran hedge fund manager, Dalio speaks extensively about the current state of the U.S. economy. Dalio, who founded the world's largest hedge fund, Bridgewater Associates, in 1975, explains the causes of the 40-year high inflation, as well as steps investors can take to protect themselves through it all. Please watch, like, and share this video as Dalio shares some important economic lessons. You could also drop your comments and observations below and subscribe for more videos like this. Let's dive right in.
What got us here is injection of a lot of debt and money. It's a hype. In other words, you can hype it up. Think of it as, you've got somebody who's weak and whatever it is, and you give them the shot, and then that shot of buying power. And if the amount of spending increases by more than the amount of production, then prices by definition go up. And so there was a massive amount of giving away checks and money. And people seem surprised that they get inflation. Well, they're going to spend that. Not going to increase very much in terms of the production. And so what is going to happen? The prices are going to go up when people spend more. Okay. And you put on top of that the issue of where we are geopolitically. We're changed the world in how resources are allocated. It used to be primarily that they were allocated on economic and profit basis. In other words, if it was more, if some place was cheaper to produce something, then capital would go there, motivated by a profit, and it would produce it and raise living standards in those places. But it would move that profit, that production, from places that would have a hollowing out, like the United States and so on, in some types of jobs. And we're now in an environment in which resources are allocated by political and ideological concerns or issues. In other words, we're not going to produce it wherever it's cheapest. And also because of worries that we might be in war, or that you could be in a war, every country wants self-sufficiency. And every country's worried, or every company is also worried, that they might be in a place where they are affected by politics. There's a paradigm shift. A paradigm shift is about a 1 in 10 year shift in the perception of what's likely and what the world is. There was a paradigm that was created by a combination of low inflation and also central banks producing free money. In other words, free money like almost zero interest rate or zero interest rates. That means you never have to pay. If you borrow the money, you don't have an interest payment. And that in many cases, you had interest-only loans and you didn't even have to pay back the principal practically, and also with low covenants. And the world recalibrated to that kind of an environment, okay? A paradigm shift is when that changes. And so Americans thought, and many people, there was a 40-year bull market in bonds, and they think cash is safe and bonds are safe. That's what they bought it for, okay? And they did not realize, essentially, what they're now realizing. What they're realizing is that you can't judge safety in the number of dollars you have. You have to judge it in the amount of buying power you have. And so if you lose money to buying power, because of inflation, you need a compensating return. So for example, with an 8% inflation and a near zero interest rate, you just lost 8% of your buying power, or almost that amount. So then that changes behaviors. As that changes behaviors, people do not want to keep their money in there. I would not keep my money in there as long as interest rates are low in relationship to the inflation rate and the likely inflation rate. You're going to lose buying power. So that's why you see money moving. It's better to borrow than to lend, and moving out of that. What that does is it creates a difficulty for the Federal Reserve, because not only the amount of bonds that have to be sold are no longer the amount of the deficit, the trade, how many bonds do you have to sell? Well, it's the amount of our deficit. We have to sell bonds for that. And if there's other selling of bonds because they're not good returns, then there has to be more and more selling. And then you have the Federal Reserve choosing to sell, that they're going to sell $1.1 trillion of bonds. So who's going to buy all these bonds? So when you look at that, that means that there's a big tightening of credit.
In his interview, Ray Dalio states that fighting inflation means taking buying power from the people. He explains further that this is why we slipped into a period of stagflation. But the Federal Reserve is trying to find a middle ground between reducing inflation and stopping the economy from slipping into a recession or stagflation. Dalio says the existing debt makes this a futile attempt. Here is the rest of the billionaire investor's interview.
Okay, we need to fight inflation, and therefore it's good that they're catching up. They were behind it. That's why we're in a period of stagflation. Central bank is going to try to find a middle ground, but there's a lot of debt and somebody's got to be paid back, and you're either going to get paid back in real money or you're going to get paid back in deflated money. And because they want to deal with both of those things and try to have a middle course, it'll produce stagflation. So what that means really is for investors is, in my opinion, don't hold money in those assets that have those kind of low returns. And then many of the bubble assets, always at the end of a paradigm, people who extrapolate what happened over the last 10 years, and they're sure it's going to happen going in the future, like tech stocks and no, that I went through this many times, the Nifty 50 or the dot-com bubble and so on. That doesn't mean that that technology companies won't do well or something. It's just like dot-com companies in terms of that, but there's a big crash in those things. A company, when it gets very expensive, it can still provide a terrible return. Some of the best companies can provide the worst returns because they get too expensive. And so we're going through that kind of a dynamic, which again emphasizes to me, don't be have a balanced portfolio and with a skew toward inflation hedge assets, although there will be in the near term, over the next probably year or maybe less, but anyway, let's call it a year or so, there'll be a tightening. That tightening causes the corrections and downward moves in most assets, because cash becomes a problem. And so then you have that correction, and then you'll have the Federal Reserve come back in, I believe, and then print a lot of money and buy more, because that's going to be the problem. So we're in that part of the cycle. You could either maintain a balanced portfolio through that, in which case, if you're having something like the all-weather portfolio or something, which is or the all-seasons portfolio that you have, that'll have that type. That's a type of time when you have the correction, but you maintain that type of balanced portfolio, because you're also seeing that the inflation hedge asset part of that portfolio does very well, although it doesn't compensate for the whole, and you ride through it, or you make the tactical moves that navigate it. So I would say that that's important. And I think international diversification is also important. Now that becomes more complicated and would get me into a longer answer than you probably have time for, but that's kind of it in a nutshell.
Ray Dalio is not the only one worried about stagflation. About 3 months ago, Mohamed El-Erian, the chief economic advisor at Allianz, said the U.S. economy was heading for a 1970-style stagflation as economic growth slowed while inflation remained elevated. We've had 6 consecutive months of economic decline, and inflation is still at a 40-year high of 9.1%. According to El-Erian and Ray Dalio, the Fed can continue to raise rates to fight inflation and worsen the economic downturn or ignore rising consumer prices with the hope that a growth slowdown will reduce inflation. What do you think is the economy's best bet, and what path is the Federal Reserve more likely to follow in the coming months? Will they continue raising rates to lower inflation or ignore high prices to stop further economic decline? Don't forget that another quarter of negative growth will have grave economic and political consequences, especially for Democrats during the midterms. Please drop your thoughts, comments, and observations in the comments section, and don't forget to like this video. Thanks for watching.